Alphabet with Gemini may have the one AI to rule them all. In this episode of Altimetry Authority, we go into what are the 4 powers that Alphabet, Google, has that nobody else does that mean that they are going to continue to see Gemini be dominant.
Meanwhile, we'll also take a look at another company that viewers recommended that we look at, which was Coreweave in the AI data center space, and maybe their prospects just aren't as good as Google's. Tune in.
Let's talk earnings and
GAAP
favorite pastime.
So let me just say, earnings
liquidity
were
of Wall Street. It's 2.5x
because their compensation goes up.
Wall Street's wrong again.
When you've got tech CEOs dropping expletives about how great your tech is, I think it's pretty clear that you have made a leapfrog forward. And I mean, Mark Benioff, right, head of Salesforce, basically came out recently and said, look, I have been a ChatGPT true believer for 3 years since it came out. And now I'm using Gemini 3 and I can't go back. And you look at it and he's not the only one that this is true. You know, you're seeing this wave of demand, and it's really a telling setup for Google in terms of why Google always the one that should have been winning. But I mean, Joel, we are seeing this massive trend, right, in terms of the data is showing Google is starting to take market share, right?
Yeah, a year ago, Google maybe had 8% of the market share of AI usage. And while the whole market has grown, Google has gone from 8 to 16%. So they've doubled their market share into a massively growing market, and you don't see that from any of the AI. In fact, if anything, OpenAI has been losing market share, and a number of others have, of the smaller ones have just been falling by the wayside. Gemini is coming back to where people expected it was. I mean, their launch was laughable. I'm talking a couple years ago, laughable. But they had all the assets to be able to make up for it, and they certainly have. And I have to tell you, in our own shop, yes, everyone started using ChatGPT a few years ago for whatever they could. But what we find is the individual tools, the Gemini notebook and the Gemini specifics, I'll say specific AI pieces, is what has really hooked people. And they've really done a great job of that. Not to mention the way they've taken Google search and have in a very cool way, I think, integrated AI with Google search, which means they still have the dominance in search. So if they can just convert search to AI instead of people stopping searching and going to OpenAI or ChatGPT, this is Gemini's they're really in line to win this all.
I gotta say though, I'm just so confused. I thought that DeepSeek was gonna win this entire market because DeepSeek Revolution Emperors. I just don't get it. Well, but everybody, for context on this, Joel will tell you that there is one podcast that I am obsessed with, which is their podcast Acquired. And I actually want to talk about because there's a really cool data point that they talked about on their most recent episode on Google. Not most recent episode, but an episode a few months ago on Google, the AI company about Google for the last 10 years. And they laid out what I thought was the most articulate reason why Google, Alphabet, is the one who's going to win. And it's that they are the only AI player that has the 4 critical things that you need to dominate in AI. One, they've got the foundational model, right? Gemini. They've actually got the transformer model, the large language model that is, deeply trained and everything else to have everything that you need. 2, they have applications that can leverage this model and also be fueled to train the model. Joel, you mentioned Google.com. I mean, everybody, it's wild when you think about, ChatGPT, the number of times that people use ChatGPT, sure, but now every single time that you use Google and you search, you are using AI. So they're actually training their model and spreading the cost of their model over infinitely more interactions than anybody else is. That helps make the model better and train it. And obviously the video that YouTube has, I mean, there's a reason why Nano Banana crushes everybody else for video and everything else.
And when you're searching on Google, they're still getting ad revenue. When people go to ChatGPT and say, I'm going to use ChatGPT for basic search, they're not getting the ad revenue. I mean, this is giving Google a massive, massive footprint, particularly when people talk about how much OpenAI is burning cash, how much they're talking about capital expenditures that are 10 to 50 times what the revenue are, future capex. And Google's like, no, we got all the cash in the world to be able to spend. And that's not coming from capital raise, that's coming from operations. So there's the financing aspect of Google is hidden behind why the great applications is another reason why Google, this is for Google to win in the AI race.
Yeah, exactly. I mean, to your point, when you're making money every single time that people use your AI and other people are paying, it's wild. And then on top of that, everybody, you've got hyperscaler capabilities, right? If you want to run an AI business, you need to actually have, I mean, look at all the money that OpenAI, everybody is paying to Microsoft, to Oracle, to everybody to be able to build these hyperscaler data centers. And Google's like, we do this in our sleep, right? We have people pay us to build it, and we're leveraging it for ourselves. I mean, Google, when you look, everybody, and it's super fascinating over the last 25 years, the skill set that they have built in terms of data center architecture is far and above everybody else. And then there's a last really important part if you want to be a dominant AI player is you need to have the chips. And I don't mean you need to be able to buy chips from Nvidia. I mean, you need to have chips that are tailored for you. And Google is Alphabet is one of the only ones who does, because they have TPUs, right? Tensor processing units. Basically what they did back in 2011, 2012, 2013 was they were buying billions of dollars of Nvidia chips. And remember correctly, I think it was Larry Page basically looked around and said, wait a second. These are the good enough solution that we're shoehorning into this idea of doing matrix math and all this other complex stuff, but we're paying somebody else's gross margin. What if we go to Broadcom and we get Broadcom to make our chips basically white label for us, way thinner margin, and we can optimize them to what we need? And so you have the Tensor TPUs. So you look, and if let's just lay out. So, right, we've got Gemini for a foundational model. Here are all the other foundational models, right? OpenAI has one, Anthropic, Meta has one with Llama, Grok for XAI, DeepSeek, Perplexity. Okay, what about great applications that leverage and train AI? Really only one other player has that, and that's Meta, right? I mean, in terms of every single one of the social media platforms that they have, that one, they can unlock AI with, and two, AI can train from. Three, hyperscaler, right? That's really Amazon, Microsoft, Meta, kind of Oracle. As we've talked about, anybody who's seen our episodes, you know what our opinion is on Oracle as a hyperscaler. And then for chips, it's really Nvidia, AMD, and Amazon. You look, there's nobody on that list that has all four other than Alphabet. Meta has three. They're doing all right. Amazon has two, right? So they're doing all right. Nobody else really has anything close. And so this is why you talk about Alphabet, and you can argue Meta a little bit, are the two that are destined to win AI because of these powers. And here's the thing. It's not just that Google now has the power of Gemini and all this other stuff. They're starting to monetize the fourth of these chips in a big way, everybody. Now, Meta is actually talking about going off of Nvidia, not 100% going off Nvidia. They're still going to buy Nvidia GPUs, but going off and actually buying some TPUs too. And so Google is doing phenomenally in terms of what they're set up. And because of that, there's a reason why the stock has effectively doubled since Liberation Day. But here's the wild thing. With all of the fundamental momentum that Alphabet has, these blue dots here, this is what Wall Street analysts are, their forecasts are for stock price, their target prices for Alphabet. Now, anybody who's been listening for a while, you know what Joel's, in my opinion, on Wall Street target prices are, but this is a classic example of why they're so ridiculous. You've got a company with wild fundamental momentum, and 75-80% of these stock prices targets are within 10% of current price or below current price. When you've got a company that literally just potentially unlocked $1 trillion business opportunity here. And so you look, and we just think that this is wild. And Joel, let's take everybody through what we're seeing when we look at Alphabet that makes Alphabet look just so compelling to us.
So this is the GAAP as reported, the GAAP as reported return on assets. That's in the orange. It is much lower than the blue, the uniform accounting, because R&D is treated as an expense because of a number of other items from leases to stock options are handled horribly by GAAP accounting, which the SEC requires companies to use. When we restate to uniform accounting for the last 50 years, we get these blue bars. This company is making, for a company of its size, to be getting a 20 to 30% ROA. Analysts think that that's going to jump in 25. So analysts are on board with this return going up. And then they're saying in 26, the analysts are saying, yeah, but it's going to be a cyclical one-hit wonder, kind of like 2021. I don't know why Wall Street analysts are so down on the name. 2 years out. It doesn't make any sense 2 years out. This is 2026 fiscal year numbers for Google. Market expectations are that they're seeing through Wall Street's 26 numbers, and they're saying, yeah, 2025 will be a good year, and it'll kind of hold slightly above that in perpetuity. That does not take into account Gemini growing from 8 to 16% market share in a massively growing market with the TPUs that they're building and all the other things, the cloud and all the other opportunities that Google has, and the fact that they can truly make money on AI already in a big, big, big way because they can integrate it with their current applications like search and YouTube and whatever else. At this point, Google looks incredibly inexpensive. Even as the stock has gone up, we think Wall Street's behind on this. At some point, Wall Street will probably realize it, and when they do, and they start recommending and ratcheting it up, we think there's going to be a lot of momentum in play, and there's a lot of reason to love Google. Alphabet.
Yeah, right. I mean, Alphabet just looks so compelling right now for all the things you said, Joel, and the fact that all those things mean ROA and fundamental momentum, everybody, is going to go way beyond this. But just let's put this in perspective. Remember what we talked about in Alphabet. Just this is the company that is primed to keep on dominating because of all of the powers that it has to control all the vectors for AI. And yet you think one of the companies that are disrupting is Nvidia. So remember those blue dots. Those blue dots, as we talked about, are the companies, the stock price forecast for Wall Street. And if you remember, for Alphabet, they were all at or below the current stock price. Nvidia, who's literally possibly getting disrupted by Alphabet, everybody's expecting them to be up 30, 40, 50%. And it's so wild. Just shows how Wall Street consistently gets this kind of stuff right. And why you can listen to Wall Street's forecast for estimates for what return on assets are, for revenue is, net income. That's what they know. But you should never listen to Wall Street target prices because there's so many reasons why they totally get it wrong. But just to put this in perspective, everybody, and part of why, as Joel and I are talking about this idea that we think Alphabet has plenty of ROA ramp potential, this is the exact same chart we just showed you for Alphabet, but for Nvidia. Those blue bars, dark blue bars, historic profitability. Light blue bars, what Wall Street is forecasting ROA to be for the next 2 years. Wall Street is forecasting Nvidia to have 150% return on assets. If Alphabet, currently a 25 to 30% return on asset business, takes some of Nvidia's gross margin and profit for their TPU business, you're seeing ROAs for Alphabet ramp, and that's before we even get into all the stuff that, Joel, you talked about in terms of all the reasons that this company is going to have ROA ramp because of the winning in Gemini, the target in the market share. So everybody, we think Alphabet looks super, super interesting right now because, again, they are the only ones with those 4 powers, right? They're the only ones with that foundational model, with the applications for it, with the data center power, and they also have the chips power. So pay attention to that. Don't get focused on anything else. That's why we think Alphabet's so interesting. But Joel, before we wrap up, we did have a viewer request us to do a 3-minute drill. And somebody requested us, everybody, to do a 3-minute drill on another person who runs data centers, slightly less compelling data center operator, Joel, Coreweave. Right? Everybody, for context, Joel and I lovingly call Coreweave the WeWork of data centers. And that is not a compliment for those of you who don't remember what WeWork did and what WeWork does. But Joel, let's take our 3-minute drill. Let's set the line for everybody to understand how this WeWork of data centers has done and what it's forecast to do and what the market's paying for.
So the GAAP accounting of Coreweave says that they're basically not making any money, that they're break even. The uniform accounting on Coreweave says, no, it actually is a lot worse. A lot worse. And when you make the adjustments to get to this, get everyone on the same playing field, you see the reality. Wall Street believes that Coreweave's returns are going to get more negative than they were this year. That's Wall Street's expectations. And then to get to current stock price of, what, $74 a share, a $44 billion market cap, I mean, it sounds like, it really does sound like the old WeWork at 40-something billion dollars with returns that have to go to 20%. Look, this essentially is just office warehousing. Nobody in office warehousing, no REITs, real estate investment trusts, are getting a 6% return when all they do is say, I'm going to provide you space. And okay, so you put the chips in there also with air conditioning, whatever else. Fine. I just don't see that being achievable. And as Coreweave, and people realize that Coreweave is having some bad years, but this is not a number that's going to, I mean, I hope they get back to like a 5 or 6%, but the stock currently requires you get to about 20 and hold in perpetuity. With the switching costs that are so easy in this space to go from Coreweave to another firm to include possibly Google, where people would just say, why do I need Coreweave? I can just go to Google Cloud and get all my AI chips there, if that's what I need, and get my own data warehouse there. What advantage does Coreweave have? I don't see any. There's no moat here. This stock is grossly overpriced right now, and I'd expect to see the stock be under heavy pressure. Don't go near it.
Right, 100%. Everybody, for context, part of the reason we also call it the WeWork of data centers is, WeWork, when it came out, it was doing something very simple. It was renting office space. That's it. There's no technology layer. They pretended there was, but there's no special unique thing about it. Well, there were publicly listed companies who rented office space. So it wasn't very hard for you to go and look and go, oh, that's actually the return on assets of an office space company. Well, guess what? There are other data center REITs out there in the world. Here's Digital Realty. Digital Realty is a data center REIT. What Coreweave is, their return on assets over the last 15 years, 3 to 4%, because that's what you make as a REIT. And that's what Coreweave is going to be also. And for everybody, you might say, well, wait a second, but why is that it's good for Google to have data centers, but it's not good for Coreweave? Well, the reason why is when Google and Amazon and Microsoft, when they have a data center business, they're not making money off of the data center. They're making money off of all the services they sell around the data center, about infrastructure as a service, around database hosting and all this other stuff. That's all these premium pricings that they have on top of it, which is not what Coreweave or Data Realty does. So to Joel's point, this is one that absolutely, even though, once again, Wall Street, those blue dots say, oh, wow, this company's going to skyrocket higher. Do not listen to Wall Street. Yet another one Wall Street's wrong again for. Avoid this. Now, everybody, if you enjoyed this conversation on Coreweave and you have a company that you want us to look at, drop it into the comments below and hit the like and subscribe button. And that is this episode of Altimetry Authority. Thanks, everybody.